There's a hedge fund that made 60% returns every year for 40 years. Nobody outside the firm can explain how. Not the regulators, not the academics, not even reportedly some of the people who work there. And here's why you should care. Right now, systems like this are managing your retirement money, billions of dollars, steered by AI that even its creators don't fully understand. When these systems fail, and they do fail, nobody knows what went wrong until after the money is gone. If your financial advisor ever told you the algorithm handles it without explaining how, subscribe. This is the series that translates what that actually means and what it means for your money when something goes wrong. Let me tell you about the most profitable hedge fund in history. Renaissance Technologies, their Medallion Fund, 60% annualized returns for 4 decades. To put that in perspective, the S&P 500 averages about 10%. Warren Buffett averages about 20%. Renaissance tripled Buffett for 40 years. How do they do it? Nobody knows. The fund is run by mathematicians and physicists, not traditional Wall Street types. They use machine learning systems that find patterns in market data, but the specific strategies? Completely secret. And reportedly, even some people inside the firm don't fully understand what the algorithms are doing. Renaissance isn't alone. Two Sigma manages $60 billion through AI. Citadel, D. Shaw, the biggest names in finance are increasingly run by machines. And here's where it gets scary. In 2024, a senior executive at Two Sigma made unauthorized changes to their trading algorithms. The result? $165 million in client losses. The SEC fined them $90 million. But here's the part that should disturb you. The firm initially couldn't detect the unauthorized changes. Let that sink in. One of the most sophisticated trading operations on Earth, $60 billion under management, couldn't monitor what was happening inside their own system. If they can't track their own algorithms in real time, what chance does anyone else have? David Wright runs quantitative strategies at a fund managing $2 billion. In April 2025, he admitted that machine learning generates up to 50% of their profits. The AI finds patterns humans literally cannot see. That's the selling point. It's also the problem. August 1st, 2012. Knight Capital is one of the largest trading firms in America. They handle billions of dollars in transactions every day. They're about to deploy a new algorithm for the New York Stock Exchange. 9:30 a.m. Eastern. Market opens. The algorithm goes live. Within minutes, something is very wrong. The system starts making erratic orders. Not dozens, not hundreds. Thousands of bizarre trades across 150 different stocks. Buying high, selling low, the opposite of what it's supposed to do. Money starts hemorrhaging, not slowly, not gradually. $10 million per minute. Let that number sit for a second. $10 million every 60 seconds, evaporating. 9:45 a.m., 15 minutes into the disaster. Knight Capital's team realizes what's happening. They see the losses piling up. They understand the algorithm has gone haywire. They try to shut it down. They can't. The system is too complex. It's not one algorithm, it's interconnected modules. Shutting down one piece without coordinating the others risks creating even more chaos. Unhedged positions, cascading failures, so they're stuck, watching their firm bleed out in real time. $10 million per minute, while the smartest engineers they have frantically try to figure out how to turn off a machine they built. 9:50 a.m., 20 minutes, 200 million gone. 10 a.m., 30 minutes, 300 million. 10:15 a.m. 45 minutes after market open, they finally achieve full shutdown. The damage? $460 million gone. In less time than it takes to watch a TV episode. Knight Capital, a firm that had operated for years, processed billions in daily trades, employed hundreds of people, was effectively destroyed. They had to be rescued the next day, sold off for scraps within months. And here's the part that should terrify you. Even after the disaster, even with all the forensic analysis, the algorithm's behavior couldn't be fully explained. They knew it malfunctioned. They couldn't fully articulate why. That was one firm, one algorithm, 45 minutes. Now imagine it's the whole market. Let me show you why these systems are unexplainable. Not secretive, unexplainable. There's a difference. Imagine you're trying to predict whether a stock goes up tomorrow. You use 3 factors: recent price momentum, trading volume, analyst ratings. 3 dimensions. You can visualize this. You can draw it on a graph. You can explain it to someone. Stocks with good momentum, high volume, and positive ratings tend to rise. That makes intuitive sense. Your brain can handle 3 factors. Now here's what the AI does. It doesn't use 3 factors. It uses 3,000. Price momentum at 20 different time scales. Options activity, short interest rates, currency movements, weather patterns, social media sentiment, correlations with thousands of other securities. 3,000 dimensions, simultaneously. Your brain cannot visualize 3,000 dimensions. Nobody's brain can. It's not a limitation of intelligence, it's a limitation of human cognition. But the AI optimizes across all 3,000 at once. It finds patterns that exist in mathematical spaces humans literally cannot access. The system discovers that when 50 specific conditions align across different markets, different time frames, different asset classes, certain stocks behave a certain way. No human can hold 50 conditions in working memory. No human can evaluate them in microseconds. That's why these strategies are unexplainable. Not because the firms won't tell you, because they exist in spaces human intuition cannot reach. Federal Reserve Governor Lael Brainerd said it directly. No one, including the algorithm's creators, can easily explain why the model generated the results that it did. That's not a failure of effort. That's not corporate secrecy. That's a fundamental property of how these systems work. And here's what makes it worse. All these AI systems train on similar data. Market prices, economic indicators, news feeds, they all use similar techniques. Neural networks, machine learning, the same mathematical approaches, which means they all learn similar strategies. When the market is calm, that's fine. But when stress hits, when something unexpected happens, they all react the same way, at the same time, in the same direction. It's not contagion, it's synchronization, and it happens faster than any human can respond. If you've been following this series, you're starting to see the picture. In the first video, I showed you how these algorithms learn to fix prices without ever communicating with each other. No secret meetings, no phone calls. The AI simply discovered that keeping prices high was more profitable than competing. Emergent collusion. Legal, invisible, extracting billions from consumers. In the second video, I showed you what happens when stress hits the market. May 6, 2010, $1 trillion erased in 36 minutes. Why? The algorithms all withdrew liquidity at the same time. When humans needed to sell, there was nobody left to buy. The machines didn't panic. They just left, all at once. And now you understand the third piece. Nobody, not the developers, not the executives, not the regulators, can fully explain what these systems are doing. They operate in mathematical dimensions human cognition cannot access. So let me put it together for you. Systems that collude without intent. Systems that amplify crashes through synchronized withdrawal. Systems that nobody can explain until after the money is gone. See where this is going? In the next video, I'm bringing it all together. Remember 2008? Complex financial instruments nobody understood. Massive leverage. Interconnected risks nobody could see until it was too late. The same pattern is repeating. Different instrument, same arrogance. And here's what's different this time. Speed. In 2008, the crisis unfolded over 18 months. The next one could unfold in 18 minutes. Your financial position. In 2008, the average American had more savings, less debt, more stability. Now, I'll show you why, when this breaks, you're going to be in a worse position to survive it than your parents were in 2008. That video drops next week. If this sounds overwhelming, if it sounds like you're powerless against forces you can't see or understand, I get it. Nobody voted for this. You didn't design these systems. You didn't deploy them. You didn't ask for your retirement to be managed by machines that even their creators can't fully explain. But you're exposed to them, whether you know it or not, whether you like it or not. Understanding that exposure is the first step. So what can you actually do? One thing, ask one question. If you have a financial advisor, if you have money in a fund that uses algorithmic strategies, ask them, can you explain in plain English how this system decides to buy or sell? Not how it's built, not the technical architecture, how it makes decisions. If they can't answer, that's not sophistication, that's opacity. And opacity is a warning sign. You can't control what Wall Street does. You can control what you understand and what you're willing to accept. Subscribe so you don't miss video 4. That's where everything comes together. That's where I show you what happens when collusion, flash crashes, and black boxes combine into something we haven't seen before. To keep producing this research, the document analysis, the regulatory deep dives, the stuff nobody else is explaining in plain English, I need your support. No sponsors from the industry I'm exposing. Check the description for how to help this channel continue. The machines are making billions using strategies nobody understands. When they fail, they'll take you with them. Unless you start paying attention now,